Hello and welcome to Connected with Latham, where we discuss ideas, legal developments and business trends shaping the global economy. Thank you for joining us for this episode, part of our Latham & Watkins Fintech Focus podcast series. I'm Simon Hawkins, a partner in the financial regulatory practice of the firm's Hong Kong office, and I'm one of the co-chairs of the firm's Global Blockchain and Digital Assets Task Force. In this episode, we're going to take a look back at the legal and regulatory trends in crypto in 2021 and making some predictions about what we might expect in 2022. Joining me today are my fellow partners and friends and co-chairs of the firm's Global Blockchain and Digital Assets Task Force, Steve Wink and Yvette Valdez, both of whom are based in New York, and Stuart Davis, who's based in London. Steve, Yvette, Stuart, thanks very much for joining me.
Thanks for having us.
Thanks, Simon.
Hi, Simon.
Okay, so we have a few topics to talk about today. One is the maturing regulatory environments and evolving policy direction, stablecoins and CBDCs, NFTs and the metaverse, and then the direction of travel in 2022. It's a lot to get through in one podcast, so we'll keep it relatively high level. But let's start with the first topic, which is looking at the regulatory environment and the evolving policy direction. So, Steve, in the US, have we seen any increased clarity around the regulatory perimeter in crypto this year? Greater certainty for market participants and customers? Tell us what you've seen in the US this year.
Well, Simon, the big news in the U.S. is Gary Gensler is the new chair of the SEC, and he's been extremely aggressive in characterizing what parts of the crypto world would be subject to the purview of the SEC, and that they might be securities. And unfortunately, he's also stated that he doesn't think further regulation or guidance is really necessary at this point. He seems to appreciate the ability to have some ambiguity so as to be able to pursue more potential causes of action. And he doesn't think, what's known as regulation by enforcement is actually a real problem. And his main focus is providing investor protection in the crypto world through application of the securities laws. So, as I said, he's been extremely aggressive in pursuing that.
One of the most interesting developments recently is we've had a lot of attention from the banking regulators regarding crypto. There has obviously the incumbent financial institutions are very focused on being able to provide crypto services. And most recently in November, there was a joint statement from the banking regulators indicating that they plan to provide greater clarity throughout 2022 and potential regulations regarding crypto asset safekeeping, traditional custody services, ancillary custody services, rules relating to loans collateralized by crypto assets. And really with a view and understanding that incumbent financial institutions are really looking to hold crypto and provide, very basic prime brokerage custody services and lending and financing to their customers. So that's pretty exciting developments. We know that the banking regulators have been fairly focused. And so these statements are really on the heels of, frankly, a whole policy review and a sprint that they've been doing this year. And so we're hopeful that we'll see something in 2022. On the CFTC side, I think what Steve said really echoes on the CFTC side as well. There has been a lot of regulation by enforcement. In fact, one of the commissioners, Commissioner Don Stump, recently last week effectively criticized the staff for all of the regulation by enforcement that's really been happening in the crypto space without appropriate interpretive guidance and notice. And in particular said it's really unfortunate that there is so much regulation by enforcement because the market doesn't have the tools to be able to comply and frankly the notice. And so I think there'll be continued focus. So I'm hopeful that in 2022 there will be more focus on interpretive guidance and regulation so that we can really scope out the jurisdictional ambit of the CFTC in the crypto space and give the market participants the necessary clarity that they obviously need.
Thanks, Yvette. There's an interesting point there. For the past couple of years, we've been talking about this intersection of traditional financial services and crypto. And from what you're saying there about sort of institutionalization, it sounds like you're seeing more of that in the US. But is it involving the traditional financial services companies, or has crypto effectively kind of leapfrogged through traditional financial services intermediation and sort of just become its own crypto native industry that's providing all of those services?
Well, I think we're seeing a little bit of both, right? A lot of the crypto natives are effectively obtaining charters and able to function like, in some ways, like financial institutions. There's specific charters in order to custody crypto, but the incumbents are clearly wanting more clarity to be able to hold the crypto as a custodian and also be able to continue to offer their typical, banking services. And that just takes more regulation and more clarity from the regulator. So a typical bank cannot do the same thing that a large crypto custodian, for instance, is doing right now. And it is going to take more regulation from the banking regulators to allow the incumbents to enter this market.
Thanks, Yvette.
I could add also, Simon, that on the security side, there's sort of two main areas. DeFi, of course, is exploding in the US generally. And yes, it is really crypto native, those actions, and trying to figure out how to sort of match those capabilities in DeFi. And we've also seen the SEC be very concerned about that. DeFi is currently under intense scrutiny by the regulators in the US, in part for these reasons and the same reasons that Gensler is concerned about investor protection overall. And we've also seen retail crypto lending is really under siege. There's been a number of investigations by the states under state securities laws and others that seems to be attempting to shut that business down in many ways, or have it at least regulated as a securities offering. So certainly lots of activity there.
Yeah, and DeFi is a really interesting area that we should come back to. But I want to turn it over to Stuart to give us a view from the UK and Europe, because I think this time last year, Stuart, we were talking about MiCA. So maybe you could give us an update on how MiCA is progressing and what are the sort of trends that we've seen this year in the UK and Europe.
Sure, Simon. Very happy to. I think before we come on to MiCA, 2021 has very much been the year of the Money Laundering Directive in Europe. That came into force in 2020, but most European jurisdictions implemented their registration regimes for MiCA in 2021. So they're coming into force now. And you're seeing the first wave of firms being registered by regulators. What MLD5 has shown is that across Europe, there's been quite a fragmentation in the market with how legislators have implemented MLD5. And the registration regimes in particular are a good example of that. Some member states are treating registration regimes like quasi-licensing or full licensing regimes, which is taking market participants upwards of 18 months to 2 years to get the registration, whereas some other European member states are implementing regimes which are much more like notification processes. So you register by notifying and you don't need to do anything else. It's a very light touch regime. So what we're seeing is participants move and adjust their businesses to deal with these different regimes. There's no passporting, which means that if you're providing services into a jurisdiction in Europe, you need to get the registration in that jurisdiction typically. A firm that wants to operate on a Europe-wide basis is having to figure out exactly where it needs registrations, what those registrations might entail, and is really going through a very different process depending on what those jurisdictions require. Looking at MiCA, that is a fulsome regulation which will be automatically incorporated into the laws of each EU member state when it comes into force, and is designed to solve for that market fragmentation. It introduces requirements for issuers of crypto assets to make market disclosures similar to prospectus requirements. It introduces licensing requirements for certain types of issuers, as well as for crypto asset service providers, so exchanges, custodians, arrangers, etc. And it introduces a pretty significant safeguarding and supervisory regime around both asset-backed and fiat-backed stablecoins, which is going to be very interesting to see how that plays out. In terms of where we are in the legislative process, the EU Commission is currently going through the trialogue stage with the Parliament, which is a process by which the Commission and the Parliament negotiate the final terms of the regulation. And that process will last quite some time until they finalise. It's anticipated that MiCA will come into force in around 2023. So we're really in this lacuna period at the moment of market fragmentation before MiCA should bring everything back together. In the UK, the Treasury has proposed a regime which would specifically attach to stablecoins. And similar to MiCA, it would impose licensing and conduct of business requirements around issuers and service providers of stablecoins. But it's not quite clear how the Treasury will respond to the MiCA proposal, because MiCA goes much further than stablecoins and covers all crypto assets that are otherwise unregulated as securities. So watch this space in 2022 as to whether the UK Treasury also decides to follow the European Commission's lead and impose a much more fulsome crypto assets regime. And just to sum up, the picture that we're seeing in Europe is much more regulation and legislators finally forcing regulators to take the supervisory control over the crypto assets industry.
So that's an interesting point. And then I did just want to come back to DeFi, which Steve had mentioned. And DeFi obviously just been 2021, arguably is sort of the year of DeFi and the year of NFTs, which we'll also talk about shortly. But how does MiCA address DeFi?
Interestingly, MiCA has a requirement that if you are a crypto asset service provider or an issuer, you must set up a legal entity, and that legal entity must be in the EU. So it'll be interesting to see how DeFi software providers who are setting up DeFi platforms will interpret that requirement. Will they be required to set up a subsidiary in the EU in order to provide the software to the platform? There's no specific regulation around DeFi in MiCA, but it's more that localization requirement that I think could pose quite a problem.
So it could then capture a DeFi platform, and the fiction that DeFi is impossible to be regulated is going to be subject to challenge under MiCA. Is that right?
Possibly. It really depends on who is deemed to be in control of the DeFi platform. And I think the way that EU regulation is structured is that if you are carrying on an otherwise regulated activity, you're controlling the platform, then you may well fall within scope of financial regulation in the EU and within the scope of MiCA, even if there isn't technically a legal entity which surrounds the platform. So I think there's going to be a similar tension in the EU as to the US. It'll be interesting to see what the final version of MiCA looks like and whether the proliferation of DeFi platforms this year will be reflected. We'll have to wait and see.
So let's move on now to the other big topic, particularly in the US in 2021, which is stablecoins. Well, we'll talk a bit about CBDCs as well, but let's park ourselves on stablecoins for the moment. Steve, can you tell us a bit about stablecoin development and the action that's been going on in the US this year?
Well, I think one of the things that was sort of surprising is, again, another Gensler set of comments along with, some report from the prudential regulators on the banking side was seeking to regulate stablecoins as securities. And I think the approach there is, looking at it as some sort of debt obligation relating to the underlying reference asset. Most practitioners prior to that statement, we're looking at it more from the Howey test expectation of profit angle and thinking, well, okay, there's no expectation in profit in these stable coins, so it shouldn't be a security. But that is another interesting angle. And unfortunately, the tests around the sort of debt obligations are much more flexible than the Howey test, which captures a lot as it is. So that is, an angle they're using that, could have some chilling effect on the market, certainly, if, depending on what happens. And we haven't seen a lot of concrete evidence, but I know there's subpoenas, investigations out there going on. So stay tuned for that. I suspect we'll hear more in 2022.
I think it's interesting to note that in the US, because we have so many regulators, there's a little bit of, fighting in the sandbox for a little bit more of jurisdiction. So Gensler statements, as Steve said, are spot on, but you also have to couple them with the CFTC's effectively counter statements, reminding everybody that virtual currencies, the definition is quite broad, and they have otherwise, through various court cases, at this point, had determined that they're broadly commodities. And so the spot trading would be subject to the enforcement authority of the CFTC to regulate against manipulation and fraud. Now, they don't have supervisory authority over it. But then that's also coupled with a recent development, which I think sort of calls into question potentially whether or not all virtual currencies are commodities. The fact that El Salvador recently made Bitcoin legal tender. And the fact that it is now effectively money in a country, has knock-on consequences to the UCC, and also calls into question whether the Commodity Exchange Act would actually potentially identify Bitcoin as currency in the Commodity Exchange Act. Currency isn't actually defined in the Commodity Exchange Act. But again, I think it does is it sort of blurs a little bit of those lines that had potentially previously had thought to be set, and certainly opens it to challenges as to whether or not its stablecoins should be considered commodities, or are they actually considered commodities? And potentially, to Chairman Gensler's point, should we be questioning them as potential securities in certain instances? So I do know, and I think it's worth noting, that not only the regulators, but certainly Congress are incredibly focused on this. There was a recent report that came out of President's Working Group on Financial Markets, which effectively called for regulation and clarity regarding the regulation of stablecoin, and pointed out the fact that, in an unregulated market, stablecoins could potentially very much destabilize the financial markets, and that Congress was really called to action to determine what those lines would look like. There were certainly recommendations, and regulators have their own views, but effectively anything from a whole new regime to really couching it within the banking regulators' ambit is, certainly up for grabs, and folks have been focused on it. And there are several bills on the House that attempt to cabin and further regulate and clarify what stablecoin issuers can do, what licenses they need, do they need to be banks, et cetera, that are sitting in Congress right now. And so I think we'll see in 2022 some form of legislation that does address stablecoin generally.
It's so interesting, I think, that, for the past few years as regulatory lawyers, we have spent the whole time, we talk about characterization of these crypto assets or virtual assets, and it's still so unclear, and there's still so much ambiguity in the US and in other jurisdictions as well. I mean, there have been efforts to create these taxonomies to help with this characterization assessment. Do you guys in the US have any updates on any progress with those initiatives?
There's been progress in terms of, we've certainly been involved from a market industry point of view in really helping move the ball forward in developing taxonomy and product categorization that works. But I think most importantly, what's sitting in the House is really going to be key, because it is very clear that we need some sort of regulation. And from that, first and foremost, we need congressional mandate for our regulators to actually be able to pass regulation as to what product categorization looks like, right? Some of the bills, like the buyer bill and the other bills, are actually focused on that taxonomy. And in fact, in the House, there's an actual bill that is the Token Taxonomy Act that is solely focused on developing standards and frankly, defining what it is that we're talking about. Because I think you're right, there is a threshold issue that we first and foremost need to understand. Is a stablecoin different from, other cryptocurrencies? That still hasn't been settled. And so, yes, I do think we need a basic framework to make sure we're all speaking the same language. But we also direly need, obviously, regulatory clarity on many other issues in the crypto space. So lots to do in 2022. I do think we're going to see movement in numerous areas and some bills passed.
A lot to keep us busy. I did just want to quickly mention CBDCs, and obviously there's been some development in some jurisdictions, but we are still quite far away from having a digital dollar, pound sterling, euro. The question has come up before, Stuart, and I think you and I have talked about this, but while stablecoins, having their moment right now, If we see fully developed CBDCs in the future, will we still need stablecoins?
It's a really interesting question. It really goes to the heart of what is a crypto asset. Is a crypto asset a currency? Is a crypto asset a property? And how does that then get incorporated into legal principles and legislation? If central banks were to issue CBDCs, I think it would take a lot of the purpose out of single fiat stablecoins. That's for sure, because who would pay to have their currency backed up by a private enterprise that could go insolvent if they could buy a currency which is backed by a central bank, which cannot go insolvent, or is very, very unlikely to go insolvent? I think where stablecoins could still be very relevant is in multi-asset territory, where you might have a stablecoin backed by money market instruments, government securities, or a multiple basket of fiat currencies. And if there's market demand for that, then perhaps that's where the stablecoin will continue to sit. There's obviously also the ideological argument. Part of the reason people initially started to look at Bitcoin as very interesting is because precisely there was no centralized trust entity and no central bank control. If you have a CBDC issued by a central bank, then yes, technologically speaking, it can probably do all of the things that a privately issued stablecoin can do, but it's controlled by the state. So maybe certain participants in the crypto asset space will have an ideological problem with that.
Thanks, Stuart.
It's very important that we get right the definition of what a stable coin is if there's some restrictions placed on them, because I worry about things like in-game tokens, payments and access tokens in games, which are very important to the operation of those projects. And if you too broadly define that, those might be inoperable. And of course, it's one of the ways that those games, the SEC, one of its very first no action letters in the whole crypto space dealt with a sort of a stablecoin structure for an in-game token. So I think that folks have always, for now a few years, have thought that that's at least one way of not having to deal with the securities regulations.
It's a super interesting space. And another super interesting space this year, and it wouldn't be a podcast about crypto without talking about NFTs or non-fungible tokens, which have absolutely entered the common lexicon this year. The market has absolutely exploded for NFTs of all types in all jurisdictions. Steve, in the US, how have the regulators responded to this new asset?
Well, it's generally been pretty quiet. The SEC at least has been pretty quiet about any specifics here. But one of the reasons is NFTs should not be, as a general matter, considered securities because, they're fully functional for their intended purpose when they're sold, that it should not be a securities. That is, for example, Beeple in the famous NFT that was sold early in the year, his efforts were complete as of the time of sale. There was no further efforts that he was going to be making that would create the value in the NFT. And that value may fluctuate subsequently, but it'd be the greater marketplace that is creating that value. Similar to an artist, Picasso's work on a painting was done when he sold it. There was no further efforts by him. So that sort of efforts of other prong of Howey wouldn't apply to that. But where we do get a little worried is when these sort of fractionalization, these structures that we're seeing more and more of, fractionalizing instruments or things could be viewed as sort of a collective investment scheme potentially. And worry about that a little bit. We also worry about using NFTs in DeFi so that they're looking more like financial instruments generally. Those are some of the concerns, but right now it's still very early days in terms of any regulatory action.
Stuart, has there been any notable direction of travel on NFT regulation in Europe? I mean, we obviously had the Financial Action Task Force has come out and said that NFTs potentially could be included in their money laundering regime and subject to money laundering regime and the travel rule for platforms that are facilitating sales in NFTs. But have there been any novel issues in UK or Europe in particular?
It's a really interesting question, Simon. We haven't yet got any NFT specific legislation or amendments to existing legislation to cover NFTs by name. But if you look at the definition of crypto assets, which is being used in Europe and in the UK for things like the Fifth Money Laundering Directive and the UK money laundering regulations, it is extremely broad. So to give you an example, the UK money laundering regulations defines an in-scope crypto asset as essentially any store of rights or value which is capable of being stored on a distributed ledger network. I'm paraphrasing a little, but it really is that broad. So query, does that cover an NFT? Well, it depends on how you build the NFT. It might not cover an NFT, which is just purely a digital certificate of authenticity, because is that really rights or value rather than just the statement of fact, a hashing? But if the NFT and the metadata to the NFT does include terms and conditions or rights that are legal rights, or if it reflects some form of underlying value, then the NFT would likely fall within the scope of an in-scope crypto asset. And the issuers of NFT or service providers of the NFT would need to comply with the Fifth Money Laundering Directive and the money laundering regulations.
Thanks, Stuart. So we'll end on some predictions or where we think the direction of travel is going to go next year, which we sort of touched upon a bit in talking about the topics today. But maybe we'll just sort of go around the three of you. If there's one thing you think you're going to be focused on working on in 2022, what do you think is going to be taking up, a big piece of your time? Steve, shall we start with you in the US?
Sure. Well, I think this continued focus on DeFi and crypto lending, I think we're going to see some interesting developments in the crypto lending area and how, that compliance with securities laws in the US is going to be addressed. So I think that's going to be a big area in the first half of 2022.
Thanks, Steve. How about you, Yvette?
Sure. I would say two things. The first is that I think the CFTC and the regulatory ambit with respect to crypto is really at an inflection point, and there's going to be necessary additional clarity and refining of the edges as to their reach in the areas that they intend to regulate, hopefully with some clear guidance and not regulation by enforcement. And the other is more clarity regarding stablecoins. I think 2022 will be the year of the stablecoin, given the clarion call that we clearly are seeing from regulators and to Congress and the interest of Congress in understanding that this clarity and legislation is key to our financial markets.
Great. And Stuart, UK, Europe, what do you think?
I think two things in the UK and Europe. Licensing and registration is going to keep everyone pretty busy. And I think also interpreting the way in which new legislation impacts some of the less well covered areas of the crypto space. You mentioned DeFi earlier, Simon, but I'd also mentioned things like staking and other areas of the technology which haven't traditionally been looked at by regulators who focused more on, core activities of exchange and custody.
Thanks very much for all of your insights, Steve, Yvette, and Stuart. It's always a real pleasure to talk to you and really interesting to talk about these emerging themes and topics that we've seen in 2021 and will continue to see in 2022. I think it's going to be a really interesting year and very busy for all of us.
Thanks for having us.
Thanks, Simon.
Yes, thanks.
And thank you all for listening to this episode in our Connected with Latham podcast series. More on this topic can be found on our Fintech blog at lw.com. You can subscribe and listen to new and archived episodes of Latham's podcasts on lw.com, Apple Podcasts, Google Podcasts, Spotify, or anywhere else you listen to podcasts. If you'd like more information about any of the topics in this podcast, please email us from the links located in the show description. We hope you'll join us again next time.
Latham & Watkins LLP. Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins LLP, and you should not send confidential information to Latham & Watkins LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things. And you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins LLP, 885 3rd Avenue, New York, New York, 10022-4834. Phone number 1-212-906-1200.